As we move into the second half of 2025, many investors are asking what's next for markets and how should I be positioning my portfolio right now. Today, we'll break down the latest data, our market outlook for the rest of 2025, and what it all means for your investment strategy. Hi, I'm Justin Kuntz, Managing Director of Pacific Wealth Management, helping you make good financial decisions through sound management for a secure future. Despite geopolitical tensions and new tariffs, the U.S. stock market is showing resilience. Inflation is calm, the Federal Reserve is holding steady, and the investor sentiment is cautiously optimistic. One of the research groups we monitor closely, Ned Davis Research, now projects that the S&P 500 will reach 6,350 by year-end. That's a modest 5% gain from the mid-June levels where we are today. It's a slight downgrade from their 6,600 forecast, but an improvement from their earlier, more cautious target of 5,500. Here's three main reasons why. First, earnings growth is cooling and now expected at just under 5%, down from 8% earlier this year. Second, profit margins are under pressure, especially from rising costs tied to new tariffs. Third, valuations. PE ratios may start to compress, which would add headwinds to growth. The Fed's basically in a wait-and-see mode through the summer, with the next possible move coming in September after the August Jackson Hole meeting, if inflation is in the range of their 2% target. If we do see a cut in September, history tells us that the S&P 500 could see a big boost. On average, we've seen 14% gains following those periods. On the inflation side of things, the numbers are actually pretty encouraging. Even with the new tariffs announcements, May's CPI figures came in cooler than expected. Both the headline and core CPI rose just 0.1% month over month. That's slower than expected. Right now, we're sitting at 2.4% for headline inflation, 2.8% for core. And if you strip out housing costs, which are notoriously sticky, we're actually under 2%. Having said that, we're still watching tariffs closely since they could drive prices higher later this year. New data shows that tariff revenue hit a record $15.6 billion in April. If companies start passing these costs on to consumers, we run the risk that inflation ticks back up into the 3% range. So what does this all mean for how you might want to think about investing for the rest of 2025? Well, there are two key themes we're watching. First, growth over value. When economic growth slows down, investors typically favor growth stocks. Think tech companies, Facebook, Google, Amazon, Apple, over value plays like banks or industrial stocks. Now, if we get hit with a recession or inflation surprises us, this could flip-flop. But for now, growth remains favored. Second, large caps over small caps. Large cap stocks typically hold up better in periods of slow but still positive economic growth. That said, small caps could surprise to the upside if we see a boost in that economic growth, or if we see a downturn after that recovery phase has begun, small caps may rebound. Overall, we're keeping a close eye on these dynamics: inflation trends, Fed moves, and corporate margins, and we'll be adjusting portfolios accordingly as they change. Markets that do have upside, but we need to stay realistic about the current risks. The volatility in April was a real stress test for investors, but we're pleased our client portfolios weathered the volatility quite well, while also participating in the rebound over the last 2 months. We're going to continue monitoring the market and adjusting as conditions evolve. I'm Justin Kuntz, Managing Director at Pacific Wealth Management. And if you're interested in seeing more about how we help our clients get the most out of their money for their life, visit us at www.pacwealth.com. Thanks a lot.